Is a 6.5% multi-year guaranteed annuity too good to be true? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. As many of our regulars have heard me say before, interest rates are still higher now than they have been on average for the past 2 decades. Here's a snippet of the weekly Treasury yield chart that we share with our VIP Investment Club members. This row shows where rates closed out at the end of last month across all the maturities that the Treasury issues at auction. And here is the average yield over the past 10 years and the average yield over the past 20 years. And what we can see here is that despite the Fed having lowered rates on the short end, interest rates are still at above average levels across the entire maturity spectrum, which also means that annuity rates remain at some of the highest levels that we've seen in recent years. And maybe something to consider for those of you in our community who are looking for a bit more stability and predictability in your portfolio in times of uncertainty. And in particular, if you have a time horizon of 3 to 7 years, as many of us do when we manage our portfolios close to retirement or when we're already in retirement. If you want to lock in current rates while they're still attractive, annuities might be one good option. But as you've also heard me say often here, annuities come in many different flavors. For example, this one from Nighthead Life at 6.5% for 7 years has crossed our desk a few times recently and does offer a very attractive yield. But some of you are wondering, what's the catch? Because as we well know, higher return usually also means higher risk. So with that in mind, here are the 3 topics that we'll be covering today. 1. Who might want to consider a MYGA, a multi-year guaranteed annuity? 2. When might a MYGA not be the right fit for you? And 3. What additional factors should you consider before purchasing a MYGA? Let's dive in now, folks. Who might want to consider a MYGA, a multi-year guaranteed annuity? As a refresher, a MYGA is a type of fixed annuity that is offered by insurance companies. The industry defines a MYGA as a fixed deferred annuity, and it works in 3 steps. First, you pay a lump sum premium to the insurance company at the beginning of the contract. Second, the amount you paid into the annuity earns a guaranteed fixed interest rate for the specific term of the contract, typically ranging from 2 to 10 years. That's where the fixed part of the name comes from. In addition, a MYGA usually comes with principal protection against market fluctuations. And third, at the end of the annuity contract or term, but not before, that's why it's called a deferred annuity, you get paid out the principal plus interest. At this point, you can either withdraw the full amount in cash, renew the contract, or convert it into another annuity product, such as a single premium immediate annuity, or SPIA, if you want to convert it into a lifetime income. You may want to consider a MYGA if you check one or more of these boxes. You are nearing retirement and want to convert the lump sum payout from a MYGA into a lifetime income stream at maturity. If you're pre-retiree considering annuitization, as the industry would say, you may be able to do this conversion tax-free. The reason is that MYGAs may often be exchanged tax-free into other annuities, like single premium immediate annuities, or SPIAs, via a 1035 exchange. And if that's an option that sounds potentially attractive to you, and you want to learn more about how SPIAs may provide you with a lifelong income to supplement Social Security and other sources, you can find the link to this bond ladder versus SPIA video below this video. You may also want to consider a MYGA if you're a conservative investor with a low risk tolerance and seeking safe fixed returns without market exposure, as a MYGA offers principal protection and predictable growth over its lifetime. You're a tax-conscious investor. For example, you're in a higher tax bracket now, and you might be able to benefit from tax-deferred growth if you can delay withdrawals until you're in a lower tax bracket. You're a long-term saver with at least a 2-year investment horizon who doesn't need immediate liquidity and wants higher yields than CDs and treasuries. You're a yield-seeking fixed income investor looking to allocate a portion of your portfolio with a horizon of up to 10 years to somewhat higher yielding but still stable low-risk assets. As I said before, MYGAs tend to pay more than CDs and treasuries currently, and especially for the 3 to 7 year Treasury ranges right now. Most of our Diamond NestEgg members, super savers, and course fans who've purchased annuities recently are age 50 plus, and they do fit neatly into one or more of these boxes. Some even fit into all of these boxes. So if this sounds like you, shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist, because there is no cookie cutter, one-size-fits-all annuity solution. Any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. Right. So now that you know who might want to consider a MYGA, let's move on to the next section of today's discussion. When might a MYGA not be the right fit for you? Here are some scenarios under which a MYGA may not be a good fit for you. You're looking for income. MYGAs are deferred annuities and only pay out a lump sum after they mature. If you need immediate and or guaranteed lifetime income, you may want to consider SPIAs, single premium immediate annuities, or fixed annuities with income riders. You need inflation protection. MYGAs typically don't adjust for inflation. If you're concerned about inflation eroding returns, you may want to take a look at TIPS and or I-bonds instead. You need liquidity. If you think you might need access to your funds before the term ends, beyond the 10% penalty-free annual withdrawal after the first year that many annuities allow, a MYGA is likely not for you due to the often high surrender charges in the earlier years. You're a long way from retirement. Early withdrawals before age 59 and a half incur a 10% IRS penalty plus taxes, making MYGAs less attractive unless held in a tax-advantaged account. You're looking for high growth. Annuities are not designed for this, and neither are CDs and most low-risk fixed income products like treasuries and agencies. For higher returns, your best bet is to go with equities or other types of investments. You're a short-term saver, meaning you have an investment horizon under 2 years. In such a scenario, T-bills, money market funds, short-term bond funds, and or CDs may be a more suitable alternative. You're uncomfortable with insurer risk. If you're someone who worries about relying on an insurance company's financial strength and are not comfortable with the guarantee funds that cover insurances at the state level, you may want to consider treasuries or FDIC-insured CDs instead. Now, let's assume that none of these boxes apply to you and that you actually fall into this group here and are now seriously considering reaching out to us to further explore a customized MYGA. There are a few more things you should note, bringing us nicely to the next section of today's discussion. What additional factors should you consider before purchasing a MYGA? There are 5 additional factors that would be at the top of my mind before purchasing a MYGA. Factor 1. How high or low are interest rates currently? As a general rule of thumb, when interest rates go up, annuity rates also tend to go up. And the reason for this is that insurance companies typically invest annuity premiums in bonds and other interest-bearing assets that track prevailing interest rates, meaning they earn more when rates are high. And some of these increased earnings are then passed on to annuity holders in the form of higher payouts. Like I said at the beginning of this video, annuity rates are at some of the highest levels that we've seen in recent years because interest rates are higher than they've been in a long time. So, if you've been thinking about MYGAs or other annuities, now may be a good time to better understand them and figure out whether one might be right for you before the Fed lowers rates again. Factor 2. What is the credit rating or default risk of the insurance carrier? All else being equal, higher MYGA rates also imply higher insurer risk, just as it works for bonds as well. Let's go back briefly to this 6.5% Nighthead Life MYGA for 7 years that we shared with you earlier. Most of the MYGAs that we've seen in recent weeks and months from the highest rated insurance companies, those that have an A++ rating, such as Guardian, MassMutual, and Northwestern Mutual, have 4 handles. A++ is the best credit rating that an insurance company can get from AM Best, which is a ratings agency that specializes in the insurance industry, meaning that the annuities from these A++ insurance companies are the lowest risk, making them the most comparable to treasuries in terms of risk-return profile. This 6.5% MYGA rate from Nighthead Life as you can probably guess, is partially a reflection of the company's lower A- credit rating. That is still solid investment grade, but it also is 3 notches below the highest AM Best rating of A++. Knighthead Life is a privately owned insurance company that was founded about 10 years ago and seems to be on the smaller and less well-known end of the insurance company spectrum, with about $10 billion in assets. But it appears to have been growing fast. Now, personally, the Lammer family prefers our insurance products from larger, more established insurance companies with the highest A++ ratings like Guardian, MassMutual, and the like. For us, at least, the whole point of insurance in general, and annuity specifically, is to provide a guaranteed payment when we need it. So we prioritize safety and track record above everything else when it comes to annuities and reserve our risk appetite for other products with potentially more of an upside. But as I always say, everyone's financial journey is different, just as everyone's annuity is different. So if you like the rate and are comfortable with Knighthead Life's risk profile, I've linked their website in the first pinned comment in case you want to have a closer look yourself. Do note that this annuity is simple interest only and that there appears to be no free early withdrawals, as you can see here. There is also a whole world of annuities out there issued by companies between the highest A++ rating and Knighthead's A- rating, with rates and features that reflect their respective profiles and can vary quite significantly. So drop us a note at jennifer@diamondnestegg.com if you're interested in exploring this world of annuities further to see which may be best for you. Key questions you might want to ask yourself about an insurer might include: how long has the company been in operation? What is their financial health? How much in assets does it have? And do you trust the insurance company to be around over the life of your annuity contract? And so on. Yes, state guarantee associations offer some level of protection in the event of insurer default, but we all would prefer not to have to rely on it, which brings us to factor 3. What is the level of annuity protection in your state? State guarantee associations offer annuity protection that can range from as low as $250,000 to as high as about $500,000, depending on the state. Make sure you understand what the limit is in your state and how this protection would work for your annuity investment if your insurer were to go bankrupt, especially if you decide to go with a lower rated or riskier insurance company. Factor 4. Does your annuity include market value adjustments, or MVAs? MVAs adjust the surrender value if you withdraw funds early beyond the typically normal 10% penalty-free amount per year that is permitted by most annuities during the surrender period. The detailed calculations can get complex, but in a nutshell, if interest rates rise after the time of purchase, a negative MVA reduces the annuity payout. And if rates fall, a positive MVA increases the annuity payout. This is again similar to bonds and how they're traded in the secondary market. Rates up, prices down, and vice versa. MVAs can complicate withdrawals, especially if you hold your annuity in a tax-advantaged retirement account where you might be subject to RMDs. So make sure you know how this feature works if it's a part of your annuity contract. And also make sure that you fully understand the tax implications in general of holding MYGAs in a tax-advantaged retirement account. MYGAs are already tax-deferred by design, so holding them in a tax-advantaged retirement account may not make sense for everyone. Factor 5. How comfortable are you with adding annuities to the fixed income allocation in your portfolio? Annuities, while they are insurance products at their core, are usually considered as part of your fixed income portfolio, meaning you could hold a mixture of bonds, CDs, and annuities in your fixed income portfolio if it fits your situation. You could even include some MYGAs as part of a bond and or CD ladder to balance out liquidity and yield. For example, investing $100,000 across 3, 5, and 7-year MYGAs, as well as T-bills or treasuries, ensures periodic access to funds while capturing some higher rates for longer terms. And if you invest your treasury allocation mostly into short-term T-bills and combine them with longer-term MYGAs, you've essentially created a barbell strategy for yourself. As I always say, it's never all or nothing when it comes to investing, and everyone's financial journey is different. So make sure you choose the annuity that's right for you, the one that's aligned with your financial goals, time horizon, risk tolerance, and tax situation. So email us at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist. All right, members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.